And we think staking for yield is a very important part of the Ethereum story. We were having a lot of trouble, therefore, getting access to Ether in our portfolio. So when Bitmine immersion came along, we thought that would be a great opportunity after it sold off significantly following the burst. We did take our position. And same with Soulmate. We have a lesser exposure to Solana, but we now have exposure to the big three: Bitcoin, Ether, and Solana. And we think all three are going to play an important role.
Hey guys, welcome to Everyday Finance. September, which is typically a bad month for stocks, has instead prepared the way for a possible fifth consecutive month of gains, defying historical norms in the stock market. It is unclear if this strength portends a long-term rally or a calm before the storm. Cathie Wood of Ark Invest, who contends that innovation and policy, not conventional cycles, are driving the economy's historic transformation, is at the center of this optimism. In addition to permanent incentives for R&D equipment and software, she points to sweeping deregulation and a new tax provision that permits full expensing of manufacturing structures for 3 years as catalysts that could lower the U.S. effective corporate tax rate to about 10%, igniting a potent wave of productivity and growth. According to Wood, the economy will transition from a rolling recession into a productivity-driven boom that will serve as a formidable deterrent to inflation, possibly bringing it below 2% and allowing the Fed to keep lowering interest rates. Wood sees gold as part of a barbell strategy that balances growth through stocks with safety in gold. This logic is extended to cryptocurrency as digital gold and stablecoins as entry points to a decentralized financial future. But underneath the optimism is a quiet concern as investors pour money into gold.
Well, we think a lot of good things are happening from a policy backdrop and therefore ultimately a macro backdrop. The deregulation that we're seeing is stunning. It started with crypto and AI. We have a crypto and AI czar now. And I think what many people have not paid enough attention to, mostly because tariffs have been getting all the headlines, given how chaotic they seem. But in OB3, so the one big beautiful bill, there was a tax policy measure that we're not sure has been integrated into many forecasts yet. And it has to do with depreciation, moving from depreciation to full expensing of structures. That has never happened before. Manufacturing structures for the next 3 years, in the first year they go into service, they will be able to expense fully in that year, as well as equipment, domestic R&D, and software. So music to innovation's ears, I would say. I think we're going to have a boom in economic activity. That first one, the manufacturing structures, is just for 3 years. The other ones have been made permanent. And so this takes our effective corporate tax rate in the United States, not statutory, that's still at 21, but the effective tax rate for the next 3 years at least is going to be roughly 10%, one of the lowest in the world. So I think we're in for some very good times. We think we're moving from a rolling recession into a recovery and then into a productivity-driven boom in activity. Well, first of all, Katie, if I could, I think that was Katie, or maybe it was Scarlett.
It was Scarlett.
Okay, Scarlett, I apologize.
All good.
So if you look at our performance in 2017 and 18, so when interest rate fears were rising and then interest rates rose, our portfolio outperformed in both years significantly. And 2018 was a down year. We were up. So I know that COVID, the boom bust around that time period, got a lot of people thinking, okay, inversely correlated to interest rate. Historically, that has not been the case. So just wanted to make that comment. In terms of the Fed, we do think interest rates will continue to come down. But if we're right, in 2026, at some point, it will be clear we're moving into a productivity-driven boom. What does that mean? Productivity is one of the most potent anti-inflationary forces. This is Reaganomics. It's deja vu. And you'll see back then, in the 20 years that ended in the tech and telecom bubble, real growth was very strong. And during those moments in time, inflation came down to surprisingly low levels. And we think that's going to be true next year as well. In fact, we would not be surprised to see inflation well below 2% next year. Well, I do think there's been a lot of uncertainty, geopolitical uncertainty especially. So it seems as though there is a barbell strategy going on here, which is equities to take advantage of lower interest rates and potentially the economic environment that I just mentioned. And then gold, just as a hedge, it seems to me. And the same has been true of crypto assets. They are much more volatile than gold, but they have also done well over time. So I think this really is a barbell strategy. We can have no comment on that. So that's what I'll say there. I will say you'll see that we have back DATs and Circle, so we're very well exposed to this crypto cycle. We think stablecoins generally, and of course Tether and Circle have 90% of the stablecoin market now. We think that is a very important entree. The holders of stablecoin will have an entree into the DeFi ecosystem, so decentralized financial services that will now take place on public blockchains. So we think that's really the definition of the next generation internet. It's the layer of the internet that was not built early on, because in the late 80s, early 90s, no one expected financial services to take place on the internet. So finally, 30 years later, we're getting the layer of the internet that is going to enable it. Yes, well, one of the reasons we did not choose to invest in one of the Ether ETFs is, at least as of now, they will not be allowed to stake. And we think staking for yield is a very important part of the Ethereum story. We were having a lot of trouble, therefore, getting access to Ether in our portfolio. So when Bitmine immersion came along, we thought that would be a great opportunity. After it sold off significantly following the burst, we did take our position. And same with Soulmate. We have a lesser exposure to Solana, but we now have exposure to the big three: Bitcoin, Ether, and Solana. And we think all three are going to play an important role.
Crypto expert Benjamin Cowan gives a more conservative perspective than Cathie Wood, who concentrates on innovation and growth. He warns that a significant structural shift is taking place in the digital asset industry, with Bitcoin poised to regain its supremacy. He cites Bitcoin's market dominance, which gauges its proportion of the overall cryptocurrency market. It currently stands at 58% and may rise to 60%, as historical trends indicate that. October might see rises of 5% to 10%, although Cowan anticipates that cryptocurrencies would perform poorly. This increase would solidify Bitcoin's dominance without necessarily causing them to plummet. According to him, Bitcoin has always led the charge in previous bull cycles, including 2017 and 2020, with altcoins following in the latter phases of the rise. He believes that one of the main factors preventing altcoin momentum is the general lack of interest in and liquidity for cryptocurrencies. According to Cowen, the present dynamic altcoins rise less when Bitcoin rises and fall harder when it retreats. That Bitcoin is gradually regaining market dominance and sets the stage for what may be the next pivotal stage in the crypto cycle.
Well, we have not bought a Bitcoin DAT, so I should be clear there. But Ether, yes. Solana, yes. Staking's a big answer to that question. In terms of the Bitcoin ETFs, I think they are illustrating that, or the Bitcoin treasuries, they are illustrating that at least in the treasury market, for whatever reasons people choose to buy MicroStrategy, maybe it now is offering a yield curve with its debt strategy for Bitcoin. So that's kind of interesting. But these are winner take most opportunities. We think that the companies that allocate assets to these new instruments, that the one that moves the fastest, the most aggressively, is probably going to win the lion's share. Maybe it's geographic. I know Metaplanet in Japan has done well, but MicroStrategy is king of the hill, obviously, here in the No, we don't. But we do think, as you say, Cathie, that they are solely, the surges are solely to get into whatever the IPO is. Now, what happened is Circle, we were a cornerstone investor, $150 million, and you saw what happened to that stock. Saw no such activity around that particular IPO. However, it seemed to give, I'm going to say, market makers and others the idea that, wait a minute, if ARK can get a big allocation to these IPOs, maybe we can benefit by anticipating which ones they will get and choose to participate in. So they've been doing that. We're seeing that. But it does take a bit of guesswork, and we don't participate in every IPO. So I don't think, I think that they'll probably be a little more judicious in doing this going forward, because I think some of this trading has caught them out flat-footed.
Yeah, the one question we always have when there is a breakup like that is, does a company lose some of the network effect in some way? Now, they were already supposed to be separate, China and the U.S. We'll see. We'll see. TikTok has been an amazing company, has taught us a lot. This is what I mean about Chinese competition. They taught our companies a lot. I will say that a company called Vine in the U.S. was the precursor, and Twitter at the time bought it, was not able to activate it in the way TikTok has, and TikTok ran away with that ball.
So would you want a piece of it?
You know, we have to do a deeper dive when we get into the data room.
Crypto's down a little bit. Bitcoin's selling off this morning. At these kind of levels, are you a buyer or a seller?
Well, we've been increasing our exposure generally to the digital asset space. I think Bitcoin has been the leader of the pack. The others are following. Ether has followed. Now Solana, and Hyperliquid is a new one, the new kid on the block. We think this is three revolutions in one: a monetary revolution, a financial services revolution, and really, in a much broader sense, a digital property rights, immutable property rights online. Never happened before, only possible because of blockchain technology.
Though from somewhat different perspectives, Cathie Wood and Benjamin Cowen both see potential in the future. Wood believes that innovation, reduced taxes, progressive policies will drive the upcoming productivity boom, which will boost all risky assets, including cryptocurrency, and spur overall economic growth. According to her, blockchain technology and decentralized finance are the cornerstones of the upcoming global innovation period, a new digital financial infrastructure that will promote stability and prosperity. Cowen, however, is more interested in the internal rhythm of the market than in its long-term potential. According to his analysis, Bitcoin's dominance is once again growing, which is a pattern that typically indicates when altcoins lose traction and Bitcoin performs better. For investors, the short term is therefore critical, although a thriving economy may eventually boost the entire cryptocurrency industry. Bitcoin appears poised to regain its prominence in the immediate future. Cowen's admonition that market transitions are rarely smooth contrasts with Wood's optimistic perspective of innovation beating inflation. Together, their opinions combine prudence and optimism. He points out that when investors seek refuge in cryptocurrency, the coin's dominance frequently increases, leaving holders of other cryptocurrencies vulnerable. Even a decrease in inflation, which is often good for markets, would make cryptocurrencies less attractive as an inflation hedge and make it harder to determine what will ultimately drive value. Underneath the euphoria, investors are expressing apprehension through significant inflows of gold and an increasing institutional focus on Bitcoin, which reveals a strong desire for growth and security in uncomfortable equilibrium. Investors must carefully manage this next phase while maintaining a long-term belief in the future driven by innovation. Cowen warns of short-term instability, which Wood depicts while being agile. Although the productivity wave may be on the horizon, the journey there is rarely smooth in the world of cryptocurrency, and those who are not paying attention run the danger of missing the turn before it occurs.